When I look back over my years in the markets, the lessons that shaped me weren't the complicated ones. They were the ones that taught me how my own perceptions shape what I see. The markets have always been simple. It's our minds that make them difficult. And today I want to share one of those foundational truths every serious trader must grasp if he hopes to create consistent success. Why volume reflects belief and conviction behind every breakout. Before we go deeper, remember this connects directly to what I have said about identifying the structure of opportunity. Because a breakout without conviction isn't opportunity at all. And recognizing genuine setups requires that you separate illusion from probability. Let me ask you, have you ever watched a chart, seen price push above resistance, and felt a surge of certainty that you just caught the start of a major move, only to watch it reverse the next day? I've lived through that emotional roller coaster many times, and what separated illusion from reality wasn't the pattern. It was the energy behind it, the conviction expressed through volume. Because the market is nothing more than the collective expression of beliefs, millions of traders placing money behind what they think will happen. When you see activity surge, that's belief crystallizing into action. Without it, a breakout is just a reflection of one or two traders acting on impulse. Momentary noise, not meaningful participation. I learned that the hard way, and maybe you have too. I used to take every breakout that appeared on the screen. The price moved above yesterday's high, I'd buy. The stock broke out of a range, I'd buy. But more often than not, those moves faded. Why? Because they lacked consensus. The market rewards alignment between collective belief and price movement. A single trader can nudge price, but only shared conviction, shown through volume, creates sustainability. That's the first point I want you to internalize. Price shows direction. Volume shows commitment. Now ask yourself, do you really want to risk your capital on a move that no one else believes in? Because that's what you do when you buy a breakout without conviction. Trading isn't a solo act. You may enter alone, you may decide alone, but your profits come from the crowd agreeing with your belief. The big money, the real growth, comes from being in sync with that collective conviction. And the reflection of that alignment is always seen in volume. When I see a breakout with volume 2 or 3 times the average, I know the belief system of the crowd has shifted. I'm not the only one seeing opportunity. And that's when probabilities favor me. Not because I know what will happen next, but because the energy behind the move tells me the market has accepted a new reality. Some traders ask, why does volume matter if price is already moving? Fair question. Think of it this way. Price can move for many reasons: speculation, manipulation, randomness. But only conviction sustains movement. In psychological terms, volume reflects agreement. When traders act in harmony, the market structure becomes stable enough to carry price forward. Without that shared belief, the move collapses under the weight of uncertainty. Volume is your evidence that enough traders believe in the same outcome. That's how you measure whether the market's energy supports your expectation. So, train your mind not just to see price movement, but to interpret the quality of participation. Look at daily turnover. Compare it to the last 10 or 20 sessions. Ask yourself, is the market accepting this price level or rejecting it? Every time I ignored that question, I paid for it, because the market always exposes impatience. Now bring it home to your own account. That capital represents your emotional energy, your patience, your belief. Why risk it on a setup that lacks consensus? That's not just poor trading. That's poor mental discipline. In Mark Douglas's language, you're sending your state of mind into an environment without support. Volume is the feedback that tells you the market agrees with your belief. Without it, you're trading your expectations against reality. So be honest. How often do you truly consider volume before taking a trade? Do you just glance at it? Or do you weigh it with the same seriousness as price itself? Because in truth, price without conviction is meaningless. Conviction without price is directionless. But when both align, price breaking structure and volume confirming belief, that's the moment when probabilities shift in your favor. Remember something. The market never lies, but it constantly tests your ability to perceive truth. The illusion of a breakout can seduce you if you focus on what you want to see, instead of what's actually there. Professionals wait for evidence, confirmation that the crowd's belief supports the move. That's why conviction, not just price, confirms every breakout. Wealth in trading doesn't come from reacting to every pattern. It comes from waiting for high probability situations and only acting when the odds are clearly stacked. And those odds are never strong unless collective belief, reflected in volume, supports the direction of price. I've seen countless traders lose fortunes chasing false signals because they confused activity with opportunity. The difference lies in confirmation, belief made visible through volume. Early in my career, I was addicted to action. I could spot setups, but I hadn't yet developed emotional discipline. When I finally learned to wait for evidence, everything changed. The market rewards patience, not cleverness. Anyone can see a breakout. Only the trader who waits for proof keeps his capital when others lose theirs. Remember, big moves don't begin quietly. They begin with acceptance. That acceptance is revealed in volume. When belief shifts, institutions step in, traders align, and you can see it in the surge of transactions. That's your signal. Not the story, not the headline, but the behavior. But don't make the mistake of thinking one day of volume tells the full story. One day can deceive you. The real confirmation lies in the days that follow. Does volume remain strong? Does the market sustain belief? A genuine breakout maintains participation. A false one loses energy. That's how you tell whether the crowd still agrees with your trade. Every trade costs you more than money. It costs you opportunity. So why tie it up in a weak setup? Trading isn't about constant action. It's about aligned action. You don't get paid for trying harder. You get paid for thinking probabilistically and waiting until the evidence supports your belief. A breakout without conviction is almost always a trap. That single truth carries more value than all the technical theories combined. The market is a living reflection of collective perception, and volume is its heartbeat. Price may show movement, but volume shows life. Think about what a breakout really is: a shift in collective perception. The crowd is watching the same resistance level, the same range. When price crosses that line, traders feel excitement, anticipation, belief that something new is beginning. But unless participation confirms it, that belief never matures. It's just a mental illusion, a temporary surge of optimism that quickly collapses. I've seen thousands of these illusions. Price breaks through resistance, holds briefly, and then fades back into the range. Traders are left frustrated, wondering how they could be wrong when everything looked right. The answer is simple. They weren't reading the conviction behind the move. They saw what they wanted to see, not what the market was showing them. Volume is the crowd's belief system made visible. When a genuine breakout unfolds, it isn't just a line being crossed. It's a psychological threshold being accepted by the collective. It's the manifestation of agreement, a rush of traders acting on a shared perception that value has shifted. You can see it in the surge of transactions, the energy that floods into the market when conviction aligns. Turnover doubles or triples, and that expansion tells you this move has real participation behind it. That's what separates truth from illusion. Without it, you're only watching a projection of hope. Let me ask you something. Have you ever been deceived by what looked like a breakout? You saw a price move past resistance, felt a surge of confidence, entered the trade, and for a fleeting moment you felt in control, only to watch it collapse. That experience isn't failure. It's feedback. It's the market exposing impatience. Every trader who endures long enough learns this lesson because the market's primary job is to reveal your weaknesses. Now, why do false breakouts occur? The answer lies in understanding how markets express energy. Sometimes large participants or even random fluctuations push price just beyond a level of structure, but without emotional commitment behind it. A few traders may act aggressively, or stops might trigger automatically. But unless the larger collective of belief, the institutions, funds, and masses, participate, there's no foundation for continuation. The move collapses because the crowd never accepted it as truth. That's why volume is your psychological barometer. Price tells you what is happening. Volume tells you if the market believes it. When volume is missing, what does that really mean? It means movement without acceptance. It's like an idea that hasn't taken root in enough minds to become reality. You may act alone, but your profits depend on alignment with the collective perception. Without volume, there's no shared belief, no energy to carry your trade forward. Acting without that alignment isn't trading. It's gambling with uncertainty. I remember countless moments from my early days when I'd rush into trades the moment they looked ready to move. I thought I was ahead of the crowd. In truth, I was ahead of confirmation, and that made all the difference. Those trades rarely worked. The missing element was always conviction, expressed through participation. When I finally conditioned myself to wait for the expansion in activity, to let the market prove it agreed with my perception, my results changed completely. My equity curve stopped bleeding, and my confidence stabilized, not because I predicted better, but because I learned to wait for evidence. Let's bring this down to something tangible. Suppose a stock trades about 1 million shares a day. It's sitting just below resistance for weeks. Then one day it breaks through, but volume is still around 1 million. The price looks good, the chart looks convincing, but the participation is unchanged. That's not acceptance, that's hesitation. Now take the same setup, but this time the stock trades 3 million shares as it breaks through. That's conviction. That's the market voting with real capital. Ask yourself, which move has a higher probability of following through? The one that looks appealing but lacks energy, or the one that's backed by collective engagement? The answer is obvious in reflection. But in the heat of the moment, most traders abandon reason for excitement. They see the surface pattern and forget to measure the belief underneath it. Never forget, breakouts without participation aren't just weak, they're dangerous. They attract traders who act on impulse and then punish them for it. Professional money knows this dynamic well. The market structure naturally tempts those who chase the illusion of early entry. Price pokes above resistance, stops trigger, emotions ignite, and without conviction, the move reverses. What looked like opportunity was just a psychological trap. That's why patience isn't just a virtue. It's a strategy. Waiting for confirmation doesn't make you late, it keeps you aligned. The market is full of traders who lose because they equate speed with skill. But consistency comes from waiting for proof. The market always offers another opportunity. but it rarely refunds the cost of acting too soon. You might think, but if I wait for volume, won't I be late? The answer is no. Real moves don't expire in a single day. When conviction supports price, trends sustain for weeks or months. Acting on unconfirmed setups may feel clever in the moment, but it's emotional gratification, not professional thinking. Acting after confirmation might feel slower, but it aligns your beliefs with the market's reality. And that alignment is where consistent profits come from. Look back at every major trend in history. You'll see the same pattern. Price expansion followed by a surge in participation. That's not coincidence. That's how belief transitions into collective action. Big moves require collective conviction, and conviction always leaves a footprint in volume. Without that, price action is just noise, a momentary emotional spike with no depth behind it. Now bring this lesson closer to your mindset. Your capital isn't just money, it's psychological energy. It represents your discipline, your patience, your confidence. To risk it on unconfirmed setups is to act without awareness. It's like sending your focus into chaos without grounding. That's what happens when you buy a breakout without confirmation. You're acting on hope, not probability. When I say a breakout without conviction is usually a false move, I'm not describing a technical rule. I'm describing a mental principle of survival. Because trading isn't about spotting every pattern, it's about managing belief, aligning with acceptance, and protecting your psychological capital. The best trades aren't those you enter first. They're the ones you enter when the market confirms your reality. Light volume breakouts are traps because they prey on impatience. If you've traded long enough, you've felt it. The surge of excitement, the certainty that you've spotted a real breakout. And then, just as quickly, it reverses, leaving you with regret. That's no accident. The market is a mirror. It reflects and magnifies your mental weaknesses until you overcome them. Think about who sets the trap. The professionals, the large participants, they know where the amateurs will react. They know the levels, the patterns, the emotions. So they push price just enough to trigger excitement, but not enough to show commitment. There's no true conviction behind it, just enough movement to make you believe. And why would they do that? Because they need liquidity. They need eager participants to take the other side of their trades. They can't sell into silence, so they create noise. They push price above a known level, trigger emotional buying, and unload into that demand. It's not manipulation. It's simply the market's way of balancing belief and reality. I've watched this unfold again and again. The stock hits a new high, participation stays muted, and the move dies. The same traders get caught, and the same lesson repeats. They trusted the picture, not the process. That's why I say the market whispers before it speaks. Price alone is the whisper. Volume is the confirmation. When participation doesn't expand with price, the market is telling you, don't believe it yet. And the trader who listens avoids the tuition fee every impulsive trader eventually pays. Think of your account as your state of mind materialized. When you risk it on unconfirmed setups, you're not just risking money, you're risking your emotional equilibrium. You're feeding impatience, reinforcing the very behaviors that keep you inconsistent. The professionals aren't beating you. They're just more disciplined and waiting for proof. Being first doesn't matter. Being aligned does. In the end, the market rewards those who wait for conviction to manifest. I had to learn that lesson the hard way. In my early days, I could spot breakouts instantly, but I couldn't yet distinguish confidence from conviction. Once I learned that the market expresses belief through participation, everything changed. Those light volume breakouts weren't signals. They were mirrors, reflecting the parts of me that still wanted certainty before evidence. They were setups, and the person being set up was my expectation. Now ask yourself this: what truly separates a false breakout from a real one? The answer isn't the line you draw on a chart, it's the collective acceptance behind that line. Real moves require real commitment. They require institutions, funds, and the broader public aligning their beliefs and acting with size. That's why genuine breakouts are accompanied by a surge in participation, because acceptance is never quiet. Without that participation, a move is a house of cards, visually convincing, structurally fragile. Professionals understand this psychology and repeatedly take advantage of traders who don't. Think of the market as a stage. The professionals are not merely actors, they are masters of framing contexts. The audience, impulsive traders, reacts to the scene. A light volume pop above resistance is theatrics that ignites emotion. The audience applauds by buying, and yet the script, written by probability, ends with a swift reversal. Those who treat the scene as truth, instead of waiting for evidence of acceptance, exit with regret. If you don't want to sit in the audience, you must train your perception to see through the scene. You do that by checking volume as a proxy for belief. There's also a psychological edge here. Professionals know that most traders can't resist the drama of a breakout. They know it triggers fear of missing out. People hate the idea of being left behind. They see a tick above resistance and think, if I don't buy now, I'll miss everything. That urgency hijacks perception. In that rush, traders forget the most important question. Where is the participation? That's exactly how the trap works, by preying on unexamined emotion. Let's make it practical. Suppose a stock averages 2 million shares a day and has been capped below $50 for weeks. One morning, it ticks to $5,100 and traders rush in, convinced they've caught the move. Volume is still 2 million, ordinary, unchanged. What's happening? It's a contextual nudge, enough motion to trigger stops and emotions, but not enough acceptance to sustain a new reality. Without participation, recognize it for what it is: bait. Change one variable. Volume jumps to 5 or 6 million, and the story changes. That's evidence of shared belief, real money stepping in. That distinction keeps you from becoming the lesson. So let me ask you, do you want to be the bait or the observer who waits for the market to reveal commitment and then participates with it? When you chase light volume breakouts, you're playing the role your emotions wrote for you. When you wait, when you demand proof in the form of strong turnover, you flip the script. You stop trading impulses and start trading confirmation. That's the only path to durability in this business. And remember, these traps aren't rare. They're everywhere because they work. They work precisely because most people won't wait. They want action, sensation, movement, anything that relieves the tension of uncertainty. But trading for stimulation funds other people's patience, not your edge. Discipline is the dividing line. Train yourself to look past the price print and read the quality of belief. Light volume to back light conviction. Light conviction, fragile structure. Fragile structure, swas low probability. If the breakout can't sustain acceptance, you have no business risking your mental or monetary capital there. Your job is not to buy every move. It's to buy the right moves. And the right moves consistently arrive with participation that confirms acceptance. I'll say it again because it matters. Professionals use light volume pops as psychological traps. They push price just far enough to make you believe in a story, but without the crowd's commitment, that story has no spine. If you buy into the story without evidence, you're outsourcing your decisions to your cravings. True breakouts, by contrast, are supported by multiple days of strong volume. That's a principle I had to engrave through both profit and pain, because it's a lesson the market repeats until you stop resisting it. One day can fool you. A single burst of excitement can seduce even seasoned traders. But markets don't measure truth in a single bar. They measure it in follow-through, in whether belief persists. That's why you can't authenticate a breakout by glancing at one day of activity. You need to see conviction carry forward across sessions. Let's walk it through. Price pushing above resistance is the event everyone watches. It's the starter's pistol. But what happens after the sound is just as important as the sound itself. On day one, volume often spikes, stops trigger, momentum participants pile in, and large traders may even add noise to amplify that first impression. The real question is psychological. Does acceptance persist after the first rush? If participation evaporates the very next day, the structure lacks foundation. That's a house built on sand. Reflect honestly. Have you ever bought the perfect-looking day one breakout only to watch it stall immediately after? It's common because the initial burst was temporary energy, not enduring belief. Real money rarely completes its process in a single session. Larger buyers work in stretches over days or weeks because size must be absorbed without telegraphing intent. That's why multiple days of strong volume are the authentic signature of commitment. They tell you the market's larger participants are actually accepting the new price area. Picture it. A firework explodes in the night, bright, loud, convincing for a moment, and then darkness returns. That's a breakout validated by a single day of high volume. Now picture a sunrise, first a glow, then a steady expansion of light, and the whole sky shifts from potential to clarity. That's a breakout supported by several days of strong turnover. One dazzles, the other establishes reality. Which would you rather finance? There's a rhythm to genuine moves, and it's visible if you care to listen. On the breakout day, the surge is obvious. The next day, price may pause or digest, but volume remains above average. The following day, buyers reassert. Turnover expands again. Day after day, participation persists, signaling the move isn't a flash, it's a transition. That's how you know the structure has backing. Consider the logistics behind the tape. Do institutions, funds, and professionals with real size complete their positions in one session? Of course not. If they showed their full hand immediately, they would deteriorate their own prices. Their accumulation stretches across days, quietly at times, but visible in the aggregate through turnover. So when you see a breakout followed by multiple sessions of above-average volume, you're not just seeing activity, you're seeing the footprint of acceptance. Align with that footprint, not against it. I can recall trades where this was written in bold across my journal. In earlier years, I'd jump the moment I saw a pattern, congratulating myself for being early. Sometimes day one looked perfect. Price surged, volume spiked, and I believed I was in sync. By day 3 or 4, participation collapsed and the stock slid back into its range. I wasn't early. I was premature. The penalty for impatience is exposure to randomness. Over time, I learned to raise my threshold. Not one day, but several. Not a firework, but a sunrise. That shift wasn't just tactical. It was psychological. It changed my relationship with uncertainty. Here's where discipline is decisive. Every trader feels the impulse to act now. You see a breakout, and you want to be in before it gets away. But ask the harder question. What if that first day is all it had? The market taxes impatience. If instead you wait, if you require, that volume confirms the move not once but repeatedly. You place yourself in a position of asymmetric probability. You may enter slightly later, but your odds improve dramatically because you're aligning with demonstrated acceptance, not imagined momentum. Think in probabilities. A breakout with one strong volume day might behave like a coin flip. But a breakout with 4 or 5 consecutive sessions of heavy turnover is no longer a 50-50 proposition. It's weight of evidence. The crowd is committed. The larger players are revealing intent through sustained participation. The likelihood of immediate collapse decreases because belief is distributed across time. Make it concrete. A stock capped at 100 finally prints $102 with 4 million shares versus its usual 1 million. That's interesting, but not conclusive. If the next day drops back to 1 million, while price merely holds, you don't have follow-through. You have hesitation. Contrast that with a sequence where day 1 trades 4 million, day 2 3.5, day 3 5, day 4 3. That's a pattern of acceptance, the market repeatedly voting, yes. That's where you want your risk deployed. Now be candid. How often has day 1 excitement blinded you to day 2 or day 3 weakness? How often did a spark impersonate a fire? The difference is always the same: sustained volume. It's the only objective proof that the crowd isn't just playing a short-term game. There's another powerful dynamic. Sustained participation reshapes psychology. Traders who missed day 1 watch the continued strength and are compelled to join. Shorts who bet on failure face mounting pressure and must cover. That secondary demand compounds the move. Each additional day of elevated turnover spreads confidence, recruits new participants, and strengthens the trend's internal support. It's a snowball of acceptance, and it begins with multiple days of volume confirming the structure.